Okay, in today's video, we have the one, the only Rick Rule. And Rick is one of the most successful natural resource, precious metals, commodities investors, really of our time. And he recently stepped down from Sprott, and he's excited about the next chapter of his life. So excited to talk to Rick in more depth here. Just want to give a shout out to our sponsor, First Majestic Silver. Thank you, Keith Newmeyer and First Majestic, for being the sponsor of this video and a dependable silver stock. So without further ado, please hit the like button on the right side right over there, the left side right over there. You know what you're supposed to do when Rick Rule comes on the channel. We comment down below, Rick Rule rules, right there down below. So it's good to see you, Rick.
Jake, it's a pleasure to be with you. I'm delighted to have the chance to visit with you and your audience again. Thank you.
Yeah, absolutely. Okay, so here's my first question. All right, so one of the most viewed videos you and I did together had, it was during the time when Warren Buffett had announced that he bought all this Barrick. It was during the run up, maybe in July or August or something. And we were discussing that. And now, you know, it's said that he's out, and we're also at a very low level, and in sentiment, the gold and silver has not went the way people thought it would. There was more correction. So my question to you was Warren Buffett right that gold is just a pet rock that nobody needs anymore? And are we in the middle of a precious metals doomsday?
Same answer I gave you the last time we talked, Keith. Pardon me, Jake. For Warren Buffett, he doesn't need gold because he's Warren Buffett. Warren Buffett is such a skilled investor, and he manages so much capital that he can allocate capital to companies that have pricing power in times of inflation. Most mortals are not Warren Buffett, so most mortals need gold. The function that gold plays fundamentally for an investor is it saves them from the depreciation of the purchasing power of their savings. Buffett does that through genius. The rest of us do it with insurance. Gold for 2,000 years has functioned as a store of value and a medium of exchange during periods of time when social circumstances or political circumstances reduced the value of people's savings. For Warren Buffett, quantitative easing is of benefit. He has high credit quality, and when money is cheaper, he uses it to make more money. Most people see artificially low interest rates as something that diminishes the yield on their savings. Warren sees it as something that lowers his cost of capital. Debt and deficits, too, don't bother Mr. Buffett so much, as the deficits go to stimulate traffic to things like Burlington Northern Railroad. So he makes money faster on the one hand than he loses it on the other. Similarly, most people who listen to your show and most people who I come into contact with are not Warren Buffett. So they need the protection that gold offers up, while Mr. Buffett doesn't.
Okay, so the last few days or so, the market's been shaky, and there's a lot of people calling for a March or an April, a market crash. You said for about a year, or like the 10 months we've had this channel, you said, you know, that you have a suspicion that at some point mainstream and Wall Street should catch up to one another. And so I'm curious your reflection on right now where, you know, you've had kind of metals going down, but you've had broader commodities going down a bit. You've had some of the bigger mainstream Wall Street stocks going down a bit. And then a lot of people are just uneasy. They're afraid everything's going to crash again. And so give me your feeling. Is this the beginning of a stock market crash or no?
I'm delighted that you asked me the question, but you asked me 4 questions. I'll try to answer 2 of them. Yeah. First of all, if you are committed to an asset class the way I'm committed to gold stocks, if you have some stocks you'd like to buy and you've worked on them hard enough that you understand their values, you're delighted to see them fall in price. There are 6 or 7 gold stocks on my buy list that I already own. But because I don't want to sell them for any price, even double what they're selling for now, I don't care if they go up a little bit, and I'm delighted if they go down because I'd like to buy more. Remember that if you like an asset, the fact that it's cheaper is a good thing, not a bad thing. People who feel trauma about declining gold prices or gold stock prices are people who don't actually believe in the asset and might not want to be in the space at all. Second thing is, you'll recall in our last interview, I said to you that from my point of view, at least, the junior gold stock market was way, way, way ahead of itself. It collapsed in its own weight. The buyers were narrative driven, not mathematically driven. And the sector itself did so many private placements, so many issuances, that they smothered demand with a flow of new issues. But more importantly, with regards to gold itself, while gold trades around many different factors, the most important are interest rates, real and nominal interest rates. The period of the increase in gold price from the third quarter of 2019 until 3 months ago coincided with a decline in the interest yield on the US 10-year Treasury from 200 basis points to 60 basis points. Coincided very nicely. The plateauing of the gold price and its subsequent decline coincided with the increase in the interest rate on the US 10-year Treasury from 60 basis points to 150 basis points. I would suggest to you, Jake, that for most people, the most important determinant, near-term determinant of the gold price is the US 10-year Treasury interest yield. Looking forward, you know me for a while now, I'm pretty unconcerned about a month or a quarter. I tend to make my money in 3 or 4 or 5 year chunks. Looking forward, I think that this gold bull market is very much intact. The Barron's Gold Mining Index that I refer to so frequently on your show is a wonderful tool to understand that. In terms of duration and dimension, gold bull markets are very frequently 10-year affairs, not 2-year affairs or 3 years affairs. And by way of dimension, the gold equity, well, the gold price, as an example, in the last gold bull market, 2000 to 2011, went from $253 an ounce to $1,900 an ounce. When people say to me, Rick, the gold prices moved from 1,100 to 1,700, is it over? I have to say, if you're a student of history, it's hardly likely that it's over. During those 10-year bull markets, during a cyclical bull market, cyclical declines in the index of 25 or 30% are commonplace. Cyclical declines of 10% occur with the frequency with which you and I inhale and exhale. People who don't realize that are people who aren't going to make money. If you believe in the arithmetic around gold, if you believe that quantitative easing, debt and deficits, and artificially low interest rates are going to depreciate the value of your savings, then you believe in gold. And if you believe in gold, you will be easily able to withstand the volatility that we see in a secular bull market. And you will come to regard 25% declines in the equity indexes as opportunities to fill in your portfolios with stocks that you wanted to own that were too expensive when you discovered them. I'm absolutely delighted with the circumstance that I see in front of me. I have an absolute belief that there is an overwhelming probability that over 2 years or 3 years, the gold market and hence the silver market and hence the gold and silver equities markets aren't merely higher than they are today, but rather are much higher today. And the fact that the markets are giving me a sale, that goods that I want to buy are on sale, that goods that I want to buy are markedly cheaper than they were 3 months ago, it's lovely. It's truly a benefit.
Okay, so then I think it was quite a while ago when you told me you were like at 40% cash. You thought things were too expensive in all different things you were investing in. And then when we talked more recently, you had started to, it was down from the 40%. Where is it now?
It's above 30%. What happened is the last time that you and I were talking, the oil stocks and the uranium stocks were just too cheap. And so I allocated to both sectors, thinking that it would take me 2 years to be right. And I was right in 2 months. When a market gives you more than you deserve in too short a period of time, you owe it to yourself and your fortune to do some selling. And so I've been a reasonably aggressive seller of the oil stocks and the uranium stocks. Not because I don't believe in them over the 2-year time frame, but when you have a basket of tiny uranium stocks that are up 200 or 300% in the short term, and the uranium price hasn't moved, what you understand is that you got more than you deserved in a quicker period of time. And you haven't actually gotten it unless you've taken it. You know, if your portfolio goes from 200,000 to 500,000 and you forget to sell, you aren't $300,000 richer. You're just $300,000 more exposed. So in the context of what happened to me in the last quarter, the market gave me too much too quick. And I'm old enough that I took it.
And when you're seeing, I guess, real quickly, since you said that on this, before I go back to gold and the economy, what is your thoughts on a lot of uranium stocks correcting? Are you rebuying, or do you think there's more ways to fall?
Listen, do I think there's more room for the juniors to fall? Absolutely. Remember that most of the juniors don't have much uranium. So if the price of something that you don't have goes up, it shouldn't matter to you particularly. The high quality junior uranium stocks got ahead of themselves too, in the sense that they won't be able to put their projects in production for a couple of years, and on a time value of money circumstance, they're ahead of themselves. But I believe that the market clearing price for uranium will be at 60 or $65 a pound, and I believe too that the market, at least the spot market, will overshoot. But when that happens, I don't think it's an if, I think it's a when. When that happens, the equities will reprice not merely higher, but way higher. But I don't think that that's going to occur in the near term. And the fact that the market was up uniformly 200 or 300% means that I think the next direction in the juniors in particular is lower, not higher. We talked too about a circumstance where the uranium equity prices rose, and all of the junior uranium companies would need to come to market to raise additional equity.
Yeah.
And they're crowding into the market. There was a recent financing by Denison where they went out to raise $30 million. And as I understand it, the book got to $250 million before the underwriter said, stop. They were more than 8 times oversubscribed in an offering that was open for 48 hours. This isn't speculation. This is mania. Now, this is, from my point of view, a very attractive company. The price was reasonably attractive. It's very well run. It's backed by the Lundins, all kinds of good things. But in a sector that's supposed to be unpopular, an offering that's open for 48 hours and is 8 times oversubscribed tell you that there's more money in the sector in the near term than the sector can handle. So I did the sector a favor. I took some money out.
All right, good deal. I had to ask you. So let's go back to, you were saying watching the 10-year and then gold, and then also just the broader economy. So we're seeing that, really move up, and there's some people that say, it's going to keep going. And then other people were calling on the Fed to do yield control to stop it. And so where do you fall in the camp? Do you think that they're going to do yield control? Do you think this is just a natural correction and a trend lower? There's people saying, how bad this is for America to have this going up because of the, precarious financial situation the government is in. What's your thoughts?
Well, you ask big questions, Jake.
You got big answers.
This is the $64 trillion question. First of all, I don't think the government should be involved in interest rates at all. I think the market should be in control of interest rates. If that happened in the near term, there would be many, many, many losers because there's a lot of debt in society. But ultimately, and it'll never happen, ultimately, I think that markets should be in control of interest rates, not governments. But let's back away from philosophy a little bit. I believe that the Fed has let the interest rate rise because they could. I believe that the economy is stronger than they thought it would be, partially as a consequence of liquidity. And I believe that they thought that if the interest rate rose, that they could then cut interest rates when they need to, if the economy falters, which I think they think, and I think it will do. It's difficult to cut the interest rate on the 10-year Treasury from 50 basis points. It's easier to cut it from 150 basis points. And it would be better yet to be able to cut it from 200 basis points if the economy allows them to do it. I personally don't believe that the economy will allow them to do it because the US 10-year Treasury is the benchmark rate. And if it holds 150, the 30-year fixed mortgage rate will increase, and it will increase fairly dramatically, which could reduce real estate prices and slow new home sales, as well as frustrate many young people who need to borrow money to buy a home. Similarly, the prime interest rate, which is the most important determinant of the cost of capital for industrial America, will go up, constraining new investment and constraining jobs growth. The interest rate on automobile purchases would increase, which would decrease automobile purchases and frustrate younger buyers who wanted to buy cars. And from the government's perspective, the most damaging would be that the interest rate that they have to pay when they roll over their short-term borrowings, federal, state, and local, would go up, and their budgets are already in deficit. So I don't believe that the interest rate goes too much higher in the near term. And I believe in the intermediate term that they will probably have to artificially lower the interest rate again. Understand that none of the political class, and frankly, most of the voters, don't care very much about the long-term future of the country. The long-term future of the country depends on the rational allocation of capital. Politicians are interested in what happens for the balance of their term. Bankers are interested in their quarterly cash bonus. If you look at the electorate, the truth is that low interest rates are part of a war on savers by spenders. And spenders are much more numerous in society than savers. So artificially low interest rates are, while extraordinarily damaging, extraordinarily popular, and I suspect they'll continue.
So when do they step in if a broader equities sell-off continues to happen and they realize they've got to do something soon? Do they wait till it happens? Because you painted
I think they wait till it happens. I think you'll need to see, as an example, the 30-year fixed mortgage rate go from 275 to 4.
Wow.
That would be painful to the housing industry. It would be painful to carpenters. It would be painful to young people trying to buy a house. They would take it out on their legislatures, and their legislators would fix it from their point of view, harm it from my point of view, in the near term. I think, too, the funding mechanism that we've used in the federal, state, and local, including yield management, has been to emphasize short-term borrowings rather than long-term borrowings. That's good when interest rates are falling, but it's hard when interest rates are rising. As you roll over that short-term paper that you've been paying a small premium to the 10-year on, debt service becomes more and more an issue, particularly when your primary non-interest budget is also in deficit. So I'm not sure that they have the flexibility in the economy, at least the political economy, to keep the interest rate high or relatively high.
Does gold continue to suffer until they do step in?
Yes.
And I know you're not really a when type of person, but when do you believe that would occur?
No idea. I mean, absolutely no idea. I'm not ducking the question.
Yeah, I know you're not.
I've tried to answer that question for 45 years with limited success.
Good deal. All right. So then let me ask you, maybe we'll get a more philosophical answer now that Rick's semi-retired. So let me ask you, you know me, I am concerned about what's happening. I am one of those people that is thinking about the long-term ramifications, and more so, even more now that I have a 7-month-old daughter, and part of me thinks it's a mistake, not a mistake. I feel bad for her. Mm-hmm. So like, I look at it and I haven't thought about it till recently. I'm like, what's going to happen when she's 40? And I think that all of these problems were already bad, but they're worse now because of the incredible amount of people that are behind on rent and mortgage, and they aren't taking salary, or they don't have a job. How, if you were a guessing man, How do you guess this plays out?
Um, Always in the long term, it plays out for the better. Our individual initiative and creativity and hard work, that is the value that we create as human beings, is so great that always over time, we overcome individually our collective stupidity.
Hmm.
But between now and then, it can be nasty, very nasty. I came up in the late 60s and early 70s when the set of circumstances that you described involved social turmoil, violence on the street. And it wouldn't surprise me if we saw a series of events that was like that. If you think about a society where every class of society, including the billionaires, feels entitled politically, and where there isn't sufficient resources in society to pay the entitlements that people believe that they're deserving, when they see other classes of society getting benefit that they don't see themselves getting, they feel aggrieved. And when people feel aggrieved, sometimes they do stupid things like kill each other. So in the near term, it wouldn't surprise me to see the sort of drama play out in society that we saw in the 60s and 70s. In the longer term, what you see is that most people fundamentally, although they make incredible mistakes in the near term, are basically good. And the fact that you're concerned about your daughter's future means that you'll take action to secure your daughter's future, which means that society won't have to, and it will right itself. You, Jake, and your young listeners need to pay a little bit less attention to things that you can't control. You need to understand that the government's not your friend, it's your enemy. You need to understand, too, that there's not much you can do about your enemy because your enemy has guns and knows how to use them. You delivering utility to your viewers and building your online business because you service your viewers means that you will be able to provide for your daughter in a way that's almost unique relative to the population. You'll need to be prudent in certain ways. You'll need to insure yourself against ultra stupidity by moving some of your assets legally offshore, by preparing yourself if you needed to, which I don't think you will, to have you and your daughter follow your money if circumstances played out worse than I think that they're going to. In particular, Jake, you've already done the most important thing. You've understood that your future is your problem, not society's problem, and that your daughter's future is your problem, not society's problem. The best thing that I think that you could do for society would be to expand your viewership to 5 million people and hammer that message home so that more young people came to believe in themselves rather than society. If 350 million people in the United States looked after themselves, society wouldn't have any obligation to them and wouldn't have any problems whatsoever.
Yeah, that really hits home, and it's something you and I haven't really dove into, mostly because we're kind of talking more about just kind of the markets and such. But it's one of my areas I love to explore with Doug. And I haven't even told you I'm starting to really look at leaving. I'm not comfortable with what's occurring. And, at the core, we talk a lot about precious metals or the markets, but at the core, I feel like the message that I want this channel to drill home is helping everybody ensure their own sovereignty. And so you touched on a couple important principles of that. And you said controlling what you can control. Now, can you give me a couple more that you think are important for someone listening to this right now, that maybe they feel overwhelmed with what's happening in the world? Maybe they're afraid, or maybe they're just struggling financially, or they realize they need to make double their net worth to get the level of freedom they need. What are their other important philosophies for us?
Well, the first thing is that being afraid is both healthy and rational, but don't be afraid to the point of paralysis. If you think somebody's about to hit you, hit them. I don't mean this literally. What I mean is that the same advice I gave you before, the most important investment you as a young person can make is in yourself. And you've done that. You've invested in your own education. Knowledge is something that can't be either taxed or stolen. The benefit of knowledge can certainly be taxed, but invest in your own knowledge. Read at least 2 hours a day. And don't read the comics. By the comics, I include the New York Times and things like that. Read real books. Save. It's important to save. It's not so important for you to save because you're making more money now than you can spend.
To me, it makes it even more important though. I'm like, I don't want to waste it. I don't want to.
Absolutely. But most young people say they can't save.
Yeah.
And they're driving late model cars to Starbucks and drinking a $3.50 cup of coffee that they can make at home for a quarter. Nickerson popularized the idea that you pay yourself first. You take 10% of pre-tax income, and before you spend a dime on anything, you save it. It's called pay yourself first. People say I can't do that, and I say bullshit. You have to do it. A whole bunch of things that we want, we confuse with a need. People believe that they're going to get unemployment benefits. They believe that they're entitled to student aid. They believe that they're entitled to Social Security, to Medicare, to Medicaid, to all those things. Ridiculous. The one who is responsible for your future and who can secure your future is you. And you begin right now by saving 10% pre-tax. Having saved the 10% pre-tax, read to learn how the world works. Read Economics in One Lesson by Hazlitt. Read The Intelligent Investor by Ben Graham. So having saved this money, that you don't waste it or speculate it away frivolously. In other words, having made the sacrifice to build wealth to become a capitalist, apply that capital intelligently. The next is, don't worry about making money. Don't worry about making money. If you focus on making money, your outlook becomes too short term. Focus on delivering utility for your customers. You, as Jake Ducey, don't worry about if your channel takes in, $10 or $12 or $13. You understand I'm underestimating the number. Worry about the utility that you generate for your users and worry about generating more utility than your competition. If you do that, the money will take care of itself in ways that will stagger you. I'm sitting, in a dream house. I've been extraordinarily lucky. And a lot of that luck came about as a consequence of a decision that I made when I was 29 years old, not to worry about making money at all, but rather to worry about generating benefit to my customers, either through product or services that were the best I could do. And by the way, substantially better than my competition. Within 90 days of making money off of a goal and replacing it with generating utility, my income doubled. And it compounded from there. I was competing with young men who wanted to own Lamborghinis. So what their imagination was occupied by was a Lamborghini. I was occupied by delivering utility to people that I competed with the Lamborghini seekers for. And the consequence of that is that I kicked their ass in the near term. I kicked their ass in the medium term, and I buried them in the long term.
Yeah, that's amazing stuff. So one of the things is I think more and more, and I, getting the amount of comments and all that stuff. One of the things that I've said a few times, I personally believe that what happens is we think that, buying this one mining stock, you see what's happening in the world, you're concerned about what's happening, you realize you need to get richer to ensure your own freedom, and you say this mining stock or this gold, this silver, this whatever, this is the thing. And personally for me, it was having a business is really what did it for me.
Right.
And, you were talking very poetically about, basically I found to be an important philosophy in my business. Do you agree with me that, especially if you have the energy and the vitality, that creating your own business in our world where, you have inflation rising, you have all the jobs not there. Do you think that that's one of the most important things to wealth generation?
For you and me, yes. Not so much for wealth generation, but rather because of our psychological makeup.
Hmm.
We can't help ourselves. I discovered fairly early on, like Doug Casey did, that I was functionally unemployable as a young guy. And I suspect that you're functionally unemployable too. You might go to work in a big bank and they tell you you have to dress like me, you have to cut your hair, and you would give them the response that they deserved. There are people who are temperamentally inclined to entrepreneurship at age 65, pardon me, 68, and filthy rich. I still come on opportunities where I believe the market's underserved and I want to start a new business. Now, this is pathologically stupid. This isn't what I should be doing. But if you have the entrepreneur's mindset, the challenge of filling a hole in the market, serving an unserved market, is almost more than you can bear. For many people, they can generate utility within a role where they don't have to be entrepreneurs, where they can work for other people. And in fact, since 2011, selling one of my businesses, Global, to Sprott, I've been an employee of Sprott, and I have thrived, absolutely thrived in the atmosphere of being an employee. Now, this is a fairly entrepreneurial culture. When I go to the board and say, I want to do this, they say, so what's the holdup? Go get it, right? My only point is that you try and arrive at a circumstance in your life where the platform that you operate on, whether working for somebody else or working for yourself, is such that you can use your interests and use your efforts to generate the maximum utility for your customer. If the company that you work for, if the job that you're in is one where the platform isn't sufficient to serve your customer, then you have to leave. You have to go find yourself another platform. It's all about delivering utility for customers, however you do that.
What do you think are the biggest mistakes right now that investors can avoid? They're looking at whether it's gold or silver or commodities, and they're saying, man, I mean, this looks like an incredible opportunity to get really rich. What are some of those?
Folks your age have this weird phrase called FOMO, fear of missing out, which is a long form for envy. They see somebody else make money and they want to make the money. In my youth, I learned that there are two fundamental forms of investment error. One is the error of omission. The other is the error of commission. Omission is money that you didn't lose, but you didn't make, and it doesn't matter. Errors of commission is where you put scratch up and lose it. Not making the money that the other guy made, but doing fine yourself. Those are errors of omission, and they don't matter. But putting $100,000 into something you don't understand and losing it, that's an error of commission. So the worst investment mistake that I can think of is fear of missing out or envy. The other thing is that sadly, Jake, people don't work hard enough. The theory of many young narrative-oriented speculators is far too often got a hunch, bet a bunch, wrapping themselves around the narrative where they don't understand anything about the investment proposition that's in front of them. People focus slavishly on share prices without having an opinion as to value. So let's say that Amalgamated Moose Pasture Mines is selling on the market for $1 a share. That's interesting information, but it's a floating abstraction unless you have an opinion as to its value. If you think that Amalgamated Moose Pasture is worth $2 a share, then the fact that it's selling for $1 is very interesting and in fact very attractive. If you think it's worth 50 cents and it's selling for $1, it's interesting, but it's not attractive. Having price information is valueless if you have no information with regards to value. In particular, if Amalgamated Moose Pasture is selling for $1 and it's worth $2 and it falls from $1 to 50 cents, because you have an opinion as to value, you know what to do. You don't freak out, you don't panic, you smile and you buy. So I think those are the important things that investors, the important risks that people need to pay attention to. Fear of missing out is a long-term phrase for stupidity. It's being afraid of the error of omission rather than the error of commission. not working hard enough. Too many times, Jake, in my rankings offer, even young people will submit these laundry lists of stocks to me, 50 stocks, 60 stocks. They can't possibly follow 50 or 60 stocks. You need to own the number of stocks that corresponds with the hours per month you're willing to spend studying those companies. Otherwise, the probability that you know anything about what you've done with this money that you've worked so hard to save is low. Why don't you just go to Las Vegas and have some fun with the money as opposed to waste it in a market that you're not taking the time to understand?
So for the last while that we've talked, you said you're back up near 40% of in cash. And every time I've talked to you, at least since I've asked the question, it's always been a number around there. And so I want to know, was there ever what's that?
I need to qualify that, Jake. It was a tactical decision 4 months ago. There are a couple opportunities in front of me which are extremely attractive, and I'm building cash to participate in that. I'm likely to participate in buying a bank. As you know, I like lending. And I'm building a business right now, which is lending money to individual investors to increase the size of their personal gold holdings, where my collateral is their gold.
Got it.
And so part of the cash levels that I have are in anticipation of very safe, very high yielding investments that are in sectors that I know extremely well, with partners that I've done business with for 40 years. This year, there are at least two, but probably three investment activities that I'm going to participate in that offer really low risk to me with very high returns relative to the returns that are available elsewhere in the market. If you came to me and said, Rick, I'm thinking about doing this, or this, but door A is investing in my own business under my own control, and the dynamics of the market are such that I'm highly confident that I can earn an above market rate of return in my own business under my control, I would tell you to throw away doors B and C. And in this circumstance, despite my advanced age, I have the ability to do a couple new things that follow on to my expertise and my Rolodex that offer me extraordinarily high rates of return with very low risk.
So my question, and it's good to know because then it gives more context to why you're at where you're at. But I guess I wonder, because I think in my head, given the amount of volatility and uncertainty in the market, and you said, well, I still think that they won't step in. They might not step in until there is that correction or form of a crash. There's a lot of people calling for it. So my question is, what is the proper number between invested versus cash at a time like this?
I don't think there is one, Jake. I think it varies for each individual. I would probably be much lower right now, except that the opportunity I see in front of me favors the allocation of capital towards these private businesses.
Okay.
The fact that a sector that I really like, which is the gold stocks, have subsectors within them that are, in historic terms, the cheapest that they've ever been, means that in a different set of circumstances, I would be much more heavily invested in the last 2 weeks in the mid-tier single asset producers that are generating lots of free cash flow.
Okay.
I already have big positions in them. So I know that when they recover, I'll recover with them. But greed would propel me there. I'm not pursuing that course of action because I have other alternatives available to me personally that, while they might not have the same upside, have upside relative to downside that's extraordinarily attractive.
Right. Okay. So here's my last big question. There's a lot of conversation. There's always been about gold and silver price manipulation, and it became probably a more discussed topic now that this whole idea of this silver squeeze was kind of brought to light more and more and more. What's the point in investing in gold and silver or mining stocks if the price is so heavily manipulated?
Uh, I have been incorrectly quoted as saying that I don't believe don't believe that markets are manipulated. I believe that all markets are manipulated in the near term. I don't believe that there's been a decade-long conspiracy to reduce the gold price or reduce the silver price, although I believe that governments talk it down all the time, because expressed faith in gold and silver is the same as expressed lack of faith in government, which hurts governments' self-image.
Uh-huh.
But markets are manipulated all the time. The idea that somebody would sell a very large amount of silver at midnight when there was nobody else in the market says that they're not trying to maximize the return on the silver that they sold, rather that they're using the price action in the physical market to spoof the paper market, which is on a daily basis. Did you know, Jake, many days, the futures market trades 200 times the available of silver for good delivery. I'm not talking about on a weekly basis or a monthly basis. I'm talking about on a daily basis. So the ability to send price signals to the futures market, which is extraordinarily leveraged from the physicals market, is huge. And the market gets manipulated a lot. But the manipulators manipulate in whichever direction is easiest. When I came into the market in the 70s, the manipulators were there in force, and they were manipulating the market higher. The spoofs that they were doing were the other way around. When interest rates were declining, and hence of that, the value of bonds was increasing, the desirability of precious metals to hedge the currency was depreciating. For 40 years, the trend in fiat currencies and bonds was higher, and the trend in physical metals was lower. They didn't need to manipulate the price of gold lower. It was doing it all by itself. Now, what I think you'll see as the price of precious metals trends for the next 4 or 5 years inexorably higher, the manipulation that you will see is in the other direction. Now, this is going to get me a lot of hate mail on your site, but that's okay. I'm an old guy, pretty bulletproof.
So what does it look like if they manipulate the other side of it?
You go the trade the other way. The way the trade works right now is you look at the futures market, you establish a short position in maybe the 120-day, maybe the 12-month, and maybe the 2-year. You leverage that position, pretty extravagantly, which they're able to do. You borrow $50 million worth of silver if you're some big bank or country or something, and that'll be nameless. You wait till there's nobody in the silver market. You pump the silver that you borrowed into the market, and you knock the market off 4.5%. You are leveraged, on margin 10-1 in the futures market. You knock that price down by 5%. You scoop in the very near term 150, 200% of capital employed. You chuckle, walk off, and wait and do it again. In the future, that trade will be done backwards. Rather than going short in the futures market, you go long in the futures market. Rather than borrowing $50 million and dumping it in the physicals market, you borrow $50 million and go long overnight in the physicals market. In other words, getting the worst possible price on the buy side that you could for your silver, and come off your leveraged long positions in the futures market. It's precisely what happened in the 70s. It's what the Hunts tried to do writ large. The Hunts figured out that the above ground silver in system available for delivery wouldn't compensate the demand, so they set about to corner it. Came very close to succeeding. In fact, if the Fed hadn't changed the rules, the Hunts would have succeeded. They would have actually broken the market.
Interesting. I've heard Jim Sinclair say the same thing. He thinks that towards the end of this bull market that the other side of it will be played and something like that will happen. So I thought that was interesting that you said that.
Well, Is it human nature? It's financial nature. Let's just say that. If they can manipulate, as has been proven that they've been able to do, a market as liquid as the US Treasury market or the LIBOR market, the fact that they could have their way with a market that's as leveraged and skinny as the silver market is a no-brainer. When I was growing up, I got to watch manipulation up close and personal. On the Vancouver Stock Exchange, I would suggest that probably 80% of the listings on the old exchange were manipulated on a daily basis. And if you had any sense of how markets worked, you could just watch it and laugh. And I think that occurs in all financial markets.
So when you say that, and the possibility of playing the other side, and then, how you've even said that it's been harder to come by some of the commercial units of silver that you've heard from your traders. When someone like Eric Sprott or Keith Neumeyer says, they believe there'll be triple digit silver, seeing now also that there's been some scarcity in the commercial market, do you give any more? I know you don't go out and say numbers, but do you think that that is a realistic scenario? Where do you rate it on a scale of 10 being an absolute and 0 being an improbability? How about that?
I don't want to get deep in the words. In my heart of hearts, and I hope you don't use this as a headline or clickbait. In my heart of hearts, it wouldn't surprise me at all to see low triple-digit silver prices. I don't consider my prejudice to be an investment fundamental, which is to say, I don't have the confidence that Eric Sprott does to make the simple declarative statement that your viewers like so much. Eric is a speculator, and I'm a loan shark. We have very, very, very different outlooks on life. I believe that the value, the purchasing power of the dollar goes down, and that assets denominated in value in dollars goes up. I believe too that instruments that are viewed by people as stores of value will become more valuable and highly coveted. We've discussed on your show before, Jake, the fact that the market share of precious metals and precious metals related assets in the United States is less than 0.5%. The 3 or 4 decade mean is between 1.5% and 2%. Gold and silver don't have to win the war against US dollar. They just need to lose it less badly. If demand for precious metals and precious metals related assets merely returned to the 3 or 4 decade median or mean, demand for that asset class would somewhere between triple and quadruple in the largest savings and investment market in the world. I can't tell you, because I don't know, where the silver price would go if demand for it quadrupled. But I can tell you that if demand for it quadrupled, that the number would be much higher rather than the same or lower. Eric and Keith can give your audiences answers that are more satisfying. I can give your audience answers that are more rational and true.
Okay, well, we got the title. Rick Rule says $100 silver by next week. So, all right. Here's my last question. So, if you took silver, if you took gold, if you took uranium, if you took other broad commodities, copper, EV type of stuff, and then you took some mainstream equities, where would you rank right now on the most attractive places to invest in if you had to rank them from forward to back? Gold, silver, uranium.
What time frame are you giving me?
As much time as you want.
If you give me 5 years, the most attractive commodity to me, price, risk versus reward, is uranium. In the very near term, the uranium stocks are way overbought. So I don't want people to hear me say that and go out and buy uranium stocks that have tripled in 3 months. That's not what I want.
Got it.
In the near term, the most attractive asset to me is cash, because I think that we're going to run into volatility. And despite the fact that cash destroys your purchasing power in the long term, in the near term, that destruction is an option premium. Having cash will give you the courage and the tools to take advantage of volatility as opposed to being taken advantage of. On a valuation basis, the asset that's most attractive to me are the gold equities, including the biggest and the best. The biggest and the best will likely underperform the little ones in a gold bull market, but merely capturing market beta in a market that could go up 400 or 500%, and doing it while de-risking it, owning the Francos and the Wheatons of the world, is, from my point of view, a very attractive proposition.
Interesting. So then I got to follow it up by asking, when you say you think cash right now, might be the most attractive due to the short-term volatility. How do you define short-term when you say short-term volatility in that instance?
As little as a month, as much as a year. There's no periodicity to black swans, Jake. Unanticipated events are by their nature unanticipated. But in my life, about every decade, we've got an event that came out of left field that clocked us. 2008 would be an example. I'm not saying that it's going to happen. If it does happen, I don't know what it is. I just know that if you have a circumstance where, as an example, the stock market is outpacing the economy, and where you have broad changes in market, which is to say, as a consequence of very low interest rates, that a 40-year bond bull market is over. When you arrive at these sea change moments, what accompanies them is volatility. I can't tell you what the volatility is going to look like. I can just tell you that it's going to occur. I suspect that the volatility index, which recently was in somnolescent territory, which is to say 10, will spend months above 20, and we'll spend weeks above 50. And that circumstance, for people who aren't psychologically and financially prepared for it, will be unnerving. For an old, fat, calm, rich loan shark like me, while I will feel genuinely sorry for the turmoil that it causes millions of people, it will be to my personal benefit.
Well, that's it makes perfect sense. So then the answer to that is basically being able right now, as I guess as a finale here to the interview, is it being able to control our emotions, or what is it in a time like this?
Well, you have to save, and you have to have saved. You need to have your intellect prepared so that you understand how to make money and you can tolerate volatility. And yes, you absolutely have to conquer your emotions. Buffett famously said that his fortune is a consequence of being brave when others were afraid, and afraid when others are brave. Right now, people are afraid of missing out, which is to say they're stupidly brave. So right now you have to be a little afraid. When, as and if, the S&P 500 sells off by 50 or 60%, and the best companies in the world are selling at earnings yields that seem incomprehensible today, people strangely panic and sell precisely when they ought to be buying. So if the psychotic break that I'm describing occurs, you have to have your wits about you and be willing to buy when your heart is screaming, sell, sell. Let me out of here.
Beautiful. Well, thank you very much, Rick. Toss it over to you for anyone that wants to have their portfolio ranked. We'll put the link in the description, but toss it over to you.
Jake, by now I've talked to or corresponded with over 1,000 of your viewers, and I really enjoy your audience. Giving them an incentive to visit with me is fairly simple, because I talk to something that they enjoy talking about, which is to say their portfolio. If you go to a website, sprottusa.com/rankings, and enter your natural resource stocks, I personally will rank them 1 to 10. I'll comment on the stocks where I think my comments might have value. And in addition, if you ask for charts in the comment section, I'll send you the Barron's 50-year gold mining stock index, and I'll send you a 100-year commodity chart that talks about how cheap the rest of the commodities complex is relative to other financial assets going back 100 years.
Beautiful. So we'll put the link in the description right there down below for everyone. Comment down below, Rick Rules right there down below. Make sure you hit the like button. I said the right button, the like button over here and over on this side to send this out to more people. Give us a subscribe and all that fun stuff. And we'll have Rick on again soon. Comment down below, Rick Rules. And Rick, thank you for coming on.
Always a pleasure, Jake. Thank you for the opportunity.
Absolutely.